Good evening, everybody. Welcome to the closing bell here at MarketStream.live. My name is Joseph Cusick with the Cusick Group Securities offered by Money Block. I got to tell you, these holiday shortened weeks, they start to grow on you. Things seem to snowball both outside the markets and inside the markets. But enough of what's going on outside of what the market action, and let's actually focus in on what's going on the markets. And we saw that the major indices, the Dow, the S&P, and the NASDAQ, all finished in the red, but they came off of their worst levels for the day. Again, still in that battle zone, but you're looking at the Dow Jones down 6 points. Finished the day at 20,651. Most of the blue chips were basically staying flat to slightly down. Not completely to be underestimated is the fact that we're in a holiday week, shortened by Good Friday, low volume. So there's not a ton of conviction behind either the bull or bear case. But at this juncture, what I am looking at is not only the movement within this 20-day and 50-day moving average range for the Dow, the S&P. I'm also watching tech. And specifically, we've seen that the NASDAQ finished below its 20-day moving average, or right at it, on the close at 53.98. That 53, what do we say? The 5400 level is that 20-day moving average. That was a critical level that you want to see held. Now, yes, it's 2 points off, big deal. So now the fight begins. But what we're seeing here is that Apple and Qualcomm, two notable names, they're in quite a little legal battle at this juncture. That not only put pressure on tech names, and specifically Apple pulling back as well as Qualcomm, but it also put some stress on the semiconductors. And I said, watch SMH. As a matter of fact, if you take a look at SMH, it finished the day down 59 cents or 0.7% at 77.83. You start to see that the semis get weak and they start to break. They challenged and broke, but did manage to bounce above that 77.35 level. That's the 50-day moving average. You start to see that tech gets weak. That's going to put some strain on the market. What was interesting, though, was that we saw the Russell 2000 finish at the best levels. They were the leaders all day. None of the topics of discussion that were going on, whether geopolitics, both economic and geopolitical policies, nothing was pulling down this small cap, domestically centric index. They may be looking at the JOLTS number, the jobs number. They may be looking at something that I am not seeing at this juncture, especially since I'm not seeing wages moving up any higher. The bottom line is that there was a little bit of a push by the bulls in the small caps. That is a positive for the markets. If, in fact, you can get some momentum from these small caps, these domestically centric stocks, that will be a very big positive. That will be a leadership role that we're going to want to watch. But, again, while the canary is not chirping, that's what I refer to the Russell 2000 as, the canary in the proverbial coal mine. I am seeing volatility at levels that we haven't seen since October of last year. Settlement above $15 is something that we haven't seen in close to 6 to 7 months. While 15 is not a huge number as far as volatility is concerned, it is a big number as far as volatility rank. If you look at the VIX implied volatility rank, it's running at around 65%, 65, which means that it's on the upper of, if you look at the last 52 weeks and the volatility curve for the last year, this is at the highest level that we've seen for basically, it's in the top tier, the top third. That's telling us that there is a heightened sense of potential violent moves in this market. Now, this consolidative action that we've seen in the indices isn't really indicating that that's really showing itself. But vol is staying up there and it's sustaining itself. I want to watch this very closely. This is a situation that we have seen very rarely in these markets. And if you are a bull, you need to be on your toes. Yes, you dug your heels in and you stayed focused and the market's held up, but was on light volume. The sellers aren't showing conviction. But I'm telling you, if we have some earnings reports that come out that are mixed, if we have geopolitical fronts that start to move and get more volatile, whether it's Syria, whether it's Korea, whether it's something in Europe, the bottom line is that this market is looking like it's setting itself up for a potential violent move. We also saw that dollar strength has waned. Dollar is finishing off of its it's finishing right off of its worst levels of the day and hovering around the 50-day moving average. Dollar bears are starting to gain some control. Now, that did help out the crude oil contract, but again, we're going to be watching the storage data that's going to be coming out and any type of economic data or earnings data that could come in, especially if we see weakness in either financials or technology. That's going to be a red flag for the crude markets, especially since we're not seeing consumption, or if we don't see consumption, or in other words, draws from the huge glut of surplus. We're going to take anything as far as an upside move in crude with a grain of salt. The Brent contract, which is represented in the Middle East, there's still supply disruptions in Libya. We're going to watch this very closely and see how that's going to continue to impact. But we also did have headlines that Saudi Arabia is now pushing to extend the production cuts past the June expiration. Now, of course, we haven't even seen the OPEC and non-OPEC numbers as far as whether or not they're adhering to these production cuts. It sounds like they are, but boy, any conflict or any sanctions that happen, for example, as we had mentioned, G7 countries are meeting to put sanctions potentially against Russia. The Russians may just turn some pumps on and say, you know what, we're going to bring some more oil to market to get some capital in. That could put stress on the Brent crude contract. Now, taking a look at the yield curves, bottom line is we saw the 10-year, and that's what I focus on. We see the price action in the 2-year and the 30-year to the upside, but the 10-year yield dropped 6 basis points. That's represented in basically looking at the price action in the 10-year. It was up 15 ticks today, and with that 6 basis point drop, basically down to 230 on the 10-year, that's telling me right now that there is not that conviction in the marketplace that we should be, or thinking that we should be seeing, especially with the way the Fed has been telegraphing that they're basically going to be raising rates. We haven't seen or heard, especially since Yellen has spoken, she did not want to tip her hand anymore about whether or not or how they were going to unwind that balance sheet. But again, I see I'm a little bit tempered on the fact that the bulls really do have the conviction that I think a lot of pundits out there are putting out there. And I'm going to watch the data for the remainder of the week. I'm going to see if volumes start to pick up, especially if we see any challenges of these critical support levels, or if we see volatility start to get above that 15, 16 level and sustained. That's telling me that there could be a new environment that is starting to come into play here, and that's where you're going to have to monitor all of your risk, monitor all of your positions, especially in those sectors that are offensive or cyclical. We're going to want to watch those very closely. That's the finance, the tech, and so forth. One thing that is also notable as we close, watch the counter-cyclical sectors. Like let's take, for instance, the real estate. IYR is an ETF. Finished the day up 44 cents or 0.5%. This has been a segment that has been beat up and now been running to the upside. We're actually seeing a major shift there. That's typically a safety. If you think of REITs, you think of yield. Take a look at the staples. The staples have actually captured a bid. You can see that they have held now over their 20-day and 50-day moving average after a challenge. Staples are starting to pick up. Again, another defensive trade. And then finally, telecom. IYZ is the telecom ETF, up a half a basis, or up 0.5% at 33.61. But again, above its 20 and 50-day moving averages, it's now getting some conviction, actually finishing the day higher than we've seen in probably 3 weeks. So you're seeing the counter-cyclical defensive areas starting to get some momentum, folks. There's a yield craving that you're not getting from the bonds, and it's starting to show up in these areas. All right, folks, that's it for the closing bell. Join me tomorrow morning. I'm going to be going over everything that's going to go on in Asia, as well as Europe and the open here in the U.S. You want to stay tuned, folks, for this is a shortened week. We're going to get some volatility, and we're going to be reporting on it here at MarketStream.live. We'll see you tomorrow.